Excited to introduce this incredible group of speakers. We've got Ben again. Thank you for moderating this session. We have Ivan, who is our tokenomics lead at Aragon, Joao, who is a chief strategy officer at M0, and Monet, who is the head of strategy at Spark. So thank you guys. I will remove myself from stage now.
Thank you, Michelle. Good to be here and good to be with a great group of panelists here. Hi, guys. How are you doing?
Doing very well. Thanks for having us on.
Good, good. Well, maybe you could just quickly introduce yourselves. Joao, you want to go first from M0?
Sure. Hey, guys. Thanks for having me. I'm Joao Reginatto. I'm Chief Strategy Officer at M0. I've been in the stablecoin sector for quite a long time now. Prior to joining M0, I spent 8 years at Circle, where I led the build out of USDC and EURC and several other stablecoin related products over there. But good to be here.
Ivan?
Hey everyone, I'm Ivan. I've been doing tokenomics with Aragon for about 4 years, and helping projects reach sustainability somehow inevitably flows through stablecoins. So I've been in the weeds of the topic for a while now as well.
And finally, but not least.
Hey, I'm Monet Supply. I've been working with Spark for the past few months, and then previous to that, I worked for Block Analitica, which is the risk service provider for MakerDAO. So, been in the stablecoin industry for about 5 years.
Great. I'm Ben Schiller. Until recently, I was a journalist at CoinDesk, managing editor, and I recently joined Miden, which is a ZK blockchain startup, and enjoying being on the other side of the kind of media fence here. So great topic, stablecoins. So obviously, most used form of crypto. We just had the Genius Act, which set rules for issuance of stablecoins here in the United States. A lot of other rules, very important piece of legislation. Joao, just want to start with you maybe. I mean, how did the Genius Act change the game for stablecoin issuers here in the United States and maybe also globally? Just give us a sense of the impact of Genius.
Yeah, the impact has been dramatic, I would say. And it seems like every day we have another example of why it was dramatic. But funny enough, and I have my own personal view of that. I've spent so much time in the sector, but there is no Genius like regulation yet, right? So actually, some people keep saying these things, which is the right thing to say. There's future Genius compatibility and compliance, but we don't have yet the law like in action. There's still a good number of months before we get to that point. So what changed?
You mean the rule making process hasn't actually taken place?
Yeah, exactly. Nobody has a license to operate under Genius yet, right? And so funny enough, when you accept that that's the case, because that's the fact, what changed is not actually regulation. I think what changed is the perception of friendliness in the regulatory regime within the US. And I think that was the dramatic thing. And I think we really need to give it to the current administration because of how fast they changed that environment, right? If you were working with anything connected to stablecoins around about 18 months ago, you actually probably didn't want anything to do with the United States, right? It was actually like fairly adversarial as a regulatory regime to stablecoins. I mean, people were still debating, can they be securities, right? And there was a whole lot of like skepticism towards things like the sharing of the upside in reserves that issuers can have access to. So I think the main thing that changed is now builders in this space realize that the environment is going to be friendly. There is going to be space for experimentation. There's going to be a very clear regulatory framework very, very soon, and clarity just helps people innovate. People feel comfortable innovating. I think that was the major shift that has happened, primarily from a sector, I think, in the industry, which has been, kind of touching this kind of technology with a lot of reluctance, which is anything that is not crypto native, right? As Monet said, like everything that has happened in core crypto use cases and environments have been using stablecoins for a long time. And I think there was no question there that that is the preferred digital dollar form factor. But everything that is sort of hybrid or more traditional in terms of use cases is moving into it. And I think this is the wave that we're seeing. Fintechs investing in it, right? Payments processors, payment networks, everybody investing in stablecoins as a piece of infrastructure that they touch.
Monet, what about you? I mean, what do you think that the challenges are for building stablecoin networks in this space? I mean, obviously everyone's got this kind of high of legislation, a changing environment, but we have to get down to the kind of practical challenges of this space. What are those challenges from your point of view?
Yeah, I work mainly kind of on like the DeFi-Native side of the stablecoin business. So it's been hugely positive seeing kind of the regulatory or the legal improvement that we've seen in the past few months. But I think how that works with DeFi has been, for the most part, left kind of out of scope. So we're still kind of waiting for how the market structure laws and regulations are going to come through, hopefully in the coming months. But yeah, it's been a huge kind of sea change in how traditional entities are looking at the space. Like just recently, Spark, we've begun working with PayPal to help scale their stablecoin. There's a whole lot of interest from numerous other fintechs, issuers, of how they can productively participate in the space. So yeah, super exciting. I think it's going to be really interesting to see how this develops, though, because now that it's in a way it's kind of like been blessed by the regulators, like you're allowed to participate in this industry. It's becoming much more crowded. So how can you differentiate yourself versus a Tether or USDC that's already scaled pretty significantly? How do you break into this industry? And I think that's questions that we're trying to find the answer to for the traditional issuers, and then also for kind of DeFi stablecoin issuers. Where do they fit in?
So just picking up on one thing you said at the beginning there. So you're saying that the Genius Act didn't really cover DeFi applications of stablecoins. It was more about the stablecoin issuers.
Yeah, I mean it's really specifically about stablecoins that are actually backed by cash equivalents.
Right.
So there's T-bill stablecoin stuff that's like cash in the bank, USDC, M0, a lot of other examples like this. And then there's kind of more the DeFi-native stablecoins, which are more like fractional reserve, and they're using decentralized smart contract systems for their backing. And these have been for the most part left out of scope. And I think the expectation is the market structure regulation is going to put a lot of definition around, what is DeFi? What if any sort of legal requirements are going to be sitting on top of decentralized protocols? So yeah, it's still up in the air. I think, recently there was a bit of a controversy about some of the Democrats bringing forward a very unfriendly proposal. So it's still kind of in play of how this is going to shake out for DeFi, although the cash-backed, sort of traditional finance-backed stablecoins, they have a lot of clarity now.
Are you referring with the proposal to the idea of not allowing rewards on stablecoins? Is that what you're referring to?
So that's something that maybe is still a bit of a challenge for the sort of T-bill backed stablecoin issuers under the the Genius Act. They're not allowed to share yield, but they can share rewards or other sort of business incentives with distribution partners, stuff of this nature. So in practice, the users and the people who are actually making the stablecoin network valuable are able to benefit somewhat from the revenue from reserves. But yeah, we'll see. The banks have been, of course, fighting very hard against that. So it's, in a sense, it's not like a closed book. We still need to make sure stablecoins are allowed to, share the economics in one shape or form.
Great. Ivan, what would you say are the main challenges from your point of view in terms of adoption of stablecoins?
I think I would say like one of the big ones is definitely that there isn't really a lot of clarity what a stablecoin actually means. Like, it's just a term that we use for pretty much anything that's pegged to an external source of price feed. We saw, so as Monet mentioned, like there is a lot of stablecoin projects that are backed by cash equivalents. There is the DeFi-Native. We've seen a lot of, in essence, like hedge funds that have a fractional share of the hedge fund being priced at $1 consistently and just being rebased to remain at $1. Like I think that creates a lot of friction for adoption from the perspective of a user. Like especially if we see some of these more exotic models start failing, like gaining user trust again would be a challenge for everyone, even those that didn't misfire, so to say. This is probably something that could be beneficial to come out from the regulation. We saw some projects like having to switch to more like synthetic dollar naming convention just to like differentiate. So I think surfacing the risk profiles of what's behind, and like, you know, in DeFi there's the perpetual question of where does the yield come from,
Right.
that like usually is pushed to the side. We're bundling a lot of things with like it's RWA backed, but there is a difference between like being backed by T-bills versus being backed by, I don't know, some business receivables. Just in terms of like the ability to serve liquidations and redemptions on a fast cycle, on the reliability of like how that asset that should be in theory one-to-one or over collateralized, how the price feed of that is being surfaced to the networks that are, you know, programmatically operating with this asset. And so I would say like that is one leg of it, and then the other one is just like the fragmentation. You know, this regulatory clarity or sort of clarity was great in terms of we've seen a lot of new projects pop up in the space, but that also has its downsides with, you know, few of these projects being actually interoperable meaningfully, which in essence means that you need just to have like hundreds of liquidity pools, because like everything needs to be paired with everything else, and there is the constant battle of like like whose platform is going to be the single liquidity hub, at which point potentially like the incumbents have the strongest leg up. And, you know, it will be kind of sad if after all this innovation we just end up with like Tether and Circle like dictating which chain is the canonical by deciding which chain they honor redemptions on. So yeah, I would say fragmentation and like this ambiguity around risks are the two main hurdles for like more sustainable usage once the farming points and yield boosts games subside. Like what the long-term struggle is going to be are those two.
Amazing. I mean, I think the kind of network wars question is really, really interesting. Joao, I mean, how do you see this shaking out? There's so many companies coming into the stablecoin space, and you're getting this fragmentation, as Ivan was saying. How do you see that resolving itself?
Yeah, I love this question. Thanks so much, Ivan, for prepping it up. Also, it's almost like we planned for this to be the case, but it wasn't the case, right? No, this is at the real core of what we are doing at M0. So it's a super close to heart kind of topic. I'll zoom out a little bit and kind of provide like a historical narrative, which, you know, like you can always take different narratives when it comes to history, but I think it's important for people to realize, as Ivan said, like the moment that we're in, because I think it's pretty different and pretty pivotal to kind of ponder on what's going to happen next. If you guys remember, as Monet said, you know, we have had for a long time now, Tether, USDT has been around for 10 years, essentially. Then USDC followed, sort of as a movement, you know, there was an opportunity seen to, you know, build these products in a way that they were more transparent and, you know, more law abiding, et cetera, at least at the time. But Circle was not the only company at the time that built those kinds of products, right? There was Paxos emerged at around the same time. Gemini had a Gemini dollar at the time. I don't know where it's gone now, but it kind of launched at around the same time. And then Paxos was the first company to sort of pivot into like a little bit of more of an as a service model, and it built the Binance dollar for Binance, and it actually built a couple of other of those instruments, and then it sort of pivoted a little bit more recently. That early emergence of those models to me was already something that's classic in the evolution of most technological transformations that we see, right? You usually start with the first iteration of a tech platform or stack, and it's usually horizontal and very general purpose in nature, right? It's like, hey, we figured out a way to do this. Now let's find how we can play a role in different types of use cases. But it's general purpose in nature. It's kind of one size fits all. The natural evolution of a lot of technological advancements is that there tends to be a subsequent phase where people realize, yeah, okay, this is kind of cool and it's amazing you can do this. By the way, there's probably lots of things that can be improved. But what about customizing it for this use case? And what about vertically integrating with this other use case? And then you naturally see solutions that are way more fragmented, but way more specialized, right? And that's good. That's usually not a bad thing. That's usually good. I mean, would you rather use, if you're in healthcare, would you rather use the vanilla like cloud solution that at first emerged, or would you rather use something that's really bespoke for the healthcare industry, right? So these things are very natural. And I think this is what we are seeing now. So at M0, we see the world in a slightly different way. I think many people get confused with this idea that we will have many different forms of stablecoins. And I think this is just a trend. We really can't oppose that trend. I mean, every week, as I said, Ben, you look at the news and there's somebody else building their stablecoin. But I think people get confused in approaching those as products. I think that's in the past. In the past, there was this idea that, you would have a vertically integrated solution where you would have an issuer, they would build a stablecoin product, and they would drive it all the way to market, directly touching their end users. Tether has been extremely successful doing that. I think, Maker and DAI were probably like fairly successful in doing that for a while as well. But Tether has been, above everybody else with the presence and the brand recognition that they have, especially in emerging markets. Now, what most people are trying to do is not really to build a stablecoin product in such a way that they also become a recognizable brand and they compete with USDC and Tether. I think that battle is over. The two guys have won, and I don't think there's going to be a third. But people are approaching stablecoins as infrastructure, right? It's not about the product that I will bring to market and then try to get adoption everywhere else. It's how I build my fintech or my crypto application, right? And if I see that as infrastructure, all of a sudden, it definitely makes a lot of sense for it to be customized for my business. Because, by the way, if I use USDC or if I use USDT, I am allowing some other entity that I most of the time have nothing to do with to monetize my customer deposit base. And why would anybody do that? I think people are realizing that that's actually a very dumb thing to do. So why wouldn't you say, I like the technology, it makes sense, but I want the feature set to be actually in this direction. I want the monetization of the customer deposit base to actually funnel to me, or to funnel to my distributors, or maybe even to go to my end users. So that customization of infrastructure, I think it's a huge trend that we will see going forward. I agree with Ivan that will naturally fragment the market. There's no doubt about that. And I think you mentioned the stablecoin network wars. I think that's a term that is beginning to emerge because people are going to try and tackle this interoperable question, this interoperability problem in different ways. And then what you see especially in the last few months, I would say, I think M0 probably is the company that showed the way, because we have been in market for 18 or 12 months at least with this kind of network of stable coins where the app developers can come in, customize them, use them infrastructure, and then we connect them in the backend with stablecoin issuers. But now you see, obviously, Bridge, which was acquired by Stripe, like obviously has a play there. Anchorage has been issuing stablecoins now for some fairly relevant use cases, right? They've done it for Tether, they're doing it for Western Union, and so on and so forth. Athena is clearly pivoting into this space. Again, we can look at their announcements in the last number of months, and they're now building this as a service. And then there are some smaller players. But I think this will be a super interesting dynamic in the sector. All these offerings, what they are going to try and do, to Ivan's point, is attack the lack of interoperability, or the fragmentation problem that you would have if you have thousands of these instruments. The approach is instead, as we think about it in M0, let's allow for any business to have their own bespoke digital dollar infrastructure, but let's ensure that all of these are interoperable. And within the M0 network, all of these technologies, all of these instruments are natively interoperable on chain. So to Ivan's point, you don't need to have several pools of liquidity because they're natively interoperable, meaning if you have Ben's dollar built on M0 and I have Joao's dollar built on M0, when you want to move from your use case to my use case, we destroy your dollars and recreate them as mine dollars, right? So we separated the behavior, which is use case bound, from the value part, which should always carry one everywhere that it goes. You shouldn't have to do price discovery in the same way that if I send you my Chase dollars, there's no market for discovering the price in terms of how many Bank of America dollars you're going to get. There's actually interoperability technology that has been built over time through central banks, clearing houses, FDIC insurance, all those things that get us to look at all these different form factors of the dollar today, which have very different risk profiles fundamentally, right? And yet allow them to interoperate. So I think that's the next phase for this sector, really looking at it from an infrastructure point of view and not from a product point of view. And I think it will cause the TAM of stablecoins as a whole to dramatically increase. We will need to look at competition from a different lens. I don't think USDC and USDT are going to go anywhere. They're going to stay and be very, very relevant products, but probably they are going to take more of a payment rail role, right? Interconnecting these use cases, and not so much as an asset that people know and hold intentionally, because that will be driven by the application. That will be driven by the fintech that you're using on your phone. You're going to honestly use whatever form factor for the dollar that they dictate to you based on the infrastructure behind the scenes.
Sorry, I was muted. Monet, would you agree with that prediction that we're going to talk more about infrastructure than products? Does that make sense to you?
Yeah, no, I think it definitely makes sense. In the past year, I think the focus has really shifted to who owns the end user, kind of what distribution channels are coming into play. So you naturally see a lot of substitution of stable coins that are not sharing any of the economics to people wanting to issue their own stable coin on a network like M0 or something like this, where their own users are actually benefiting them. They've developed these user relationships. They should capture most of the economics. It's quite natural. I do think that there's still I believe that there's going to be multiple of these sort of stablecoin issuance networks. And there's still going to be, points of contact between them. So I think, although you can off ramp the dollars and then wire it to somewhere else and remint via another network, I think there's going to be a place for on-chain sort of liquidity optimization to make them interoperable, at the speed of the internet rather than having to go, deal with wire transfers and money off chain. So yeah, I think that's somewhere we're actually, DeFi protocols and other sort of on-chain incentive mechanisms can bring utility to help integrate these different networks into one giant just overall dollar network on chain. So I think that, yeah, DeFi protocols, I think, will play a big role in that. And then also, when you are developing these on-chain products using stablecoins as the enabling infrastructure, you still need to, figure out how do you provide the liquidity to make the product work as you intended. Looking at Coinbase's on-chain loans product that they launched using USDC as the borrowable asset. They're still relying on external liquidity providers, many of them DeFi protocols like Spark, to make sure that the borrow demand can be met with supply on the other side. So yeah, I think that it's going to be a huge opportunity for protocols in the DeFi space to kind of meet these specific niches where there's a need for interoperability between networks, and then also just supporting the liquidity and the use cases that these various fintechs and wallets and businesses are spinning up using stablecoin infrastructure.
Ivan, what about you? I mean, surely we're going to see some, differentiation between these networks, though. I mean, not everything's going to just become one big interoperability system. I mean, they're going to be advantages to using one system or another.
Yeah, for sure. I think I would say I agree that we're in the infrastructure epoch. I think before the previous one, from my perspective, was the issuer one, not so much the product, because there was this time frame during which it was like, oh, like, there a lot of the growth was driven by issuers that are looking on chain and they're like, I can borrow from, let's be real, like less sophisticated lenders at rates that if I go to like an investment bank to evaluate the risk profile of my business is gonna, I don't know, ask for 15%. I can like mint my debt as a stable coin on chain and borrow at 11 because these people are just worse at evaluating the risk associated with my business. And I think we are hopefully coming to the tail end of that, because if we match that with the next age where an app is going to dictate what sort of stable coin the users are going to use, the users on the app are going to use, like that transfer of risk and obscurity is going to be, in my view, very dangerous for the user. So I think like there is, to quote the great Uncle Ben, with great power comes great responsibility. So I think like it will be very important for these apps that are going to be making decisions and quite important ones on behalf of their user base. It will be really important for them to like have some sort of like a consistent and transparent risk framework of like okay, why are we using one? Why are we picking one asset or another? And like that should come with the corresponding transparency of like, this issuer is giving me like rev share shouldn't be the key decision on, how are you picking which asset to offer to your users. Right. So I think there's going to be room to differentiate around, can you guarantee censorship resistance for these assets, right? Like is there a central like mint redeem entity, or is it an immutable contract that cannot be controlled, that mints and redeems and provides this interoperability across assets? So I think there is space to differentiate. I would say one of the challenges is that that differentiation is going to happen at a surface that most people are not going to notice until it actually matters, right? You wouldn't care that whoever is minting the stablecoin that you're using can censor you until you get censored. So I think there is like there is a lot of room for differentiation. It's a question of like, can we surface the non-monetary value of like how some of these networks are just a better product for the user.
All right, great. Fortunately, we only have 2 minutes left, so just to give us a quick kind of sense of where we're going in the future, Joao. 2 years' time, what's the world going to look like in terms of stablecoins? Just give us a couple of quick thoughts.
Yeah, I think I'll touch on something that Ivan mentioned in his last answer. I agree. I think another way to look at this is how the prior phase of the stablecoin sector was very much focused on the issuance layer, and I think naturally now the focus will be on the what I call the application layer. So it's how are these application developers making good decisions, as Ivan said. Are they picking the right infrastructure for the right reasons and not because somebody's paying them or sponsoring them heavily to do that. I think we're going to see failures. We're going to see failures of fintechs blowing up because of stablecoin infrastructure decisions they have made. We actually have had those already back in the Luna days, but I think we will have another wave of that because they will proliferate way more. But I think what we will see is over time, and I don't know, you said 2 years, maybe that's too early. But I think we will see a diminishing of the importance that has been assigned to the issuance layer of these instruments. I think, today, if you use Robinhood, do you really know like who is the custodian of the equities over there? Like there are a lot of like layers to these products, and some of these layers have been commoditized and pushed down the stack. I think a similar thing will happen to the issuance layer, and the value will be on these ancillary services, right? Do you offer on and off ramps? Do you offer liquidity? Do you offer good risk management? I think that's where the value is going to be for these application developers building these solutions. Great.
Unfortunately, we're out of time. So Ivan, Monet, I'm sorry for cutting you off, but Michelle is here already, so we have to wrap this up. Thanks so much for your time. Obviously, we're going to be watching the space very closely in the next few years, but thank you for your time today.
Thank you so much.
Thanks for having us.
Thanks for having us.